39%.
Mm-hmm.
I just want you to hold that number in your head for a second.
Mm-hmm.
Imagine you open up your portfolio, you look at a stock, and you see a potential upside of nearly 40% just sitting there.
It's the kind of number that makes you stop scrolling.
It really is.
It makes you actually pay attention. It's a very bold figure.
Exactly. And that is precisely what IDBI Capital is projecting for Apeejay Surrendra Park Hotels in their latest report. This is from February 2026.
Right.
We're doing a deep dive today into their Q3 results, and let me tell you, as I was reading through this, I realized this is not just a story about renting hotel rooms.
No, it's so much more layered than that. If you just look at the stock ticker, you really miss the actual story.
You do. It's a story about revenge travel, kind of maturing into something, well, something permanent.
Yeah.
It's about this legendary pastry brand that is absolutely crushing it. I mean, wait until you hear the sales figures.
Oh, they're incredible.
And it's about some hidden real estate value that I think most people probably just miss completely.
You really hit on the three main pillars there. We have the IDBI Capital report right here, and it's giving us the hard numbers. Their target price is RS 175.
Right, against a current price of what, about RS 126?
About that, yeah. So our mission today is to figure out why. Why this specific hotel chain, and why now in February 2026.
So let's break this down before we even get into the hotel's performance. And some of those occupancy numbers are honestly kind of wild. We need the big picture.
The context, yeah.
The report talks about a sustained uptrend in the industry. But, we hear phrases like that all the time. What does that actually look like on the ground?
Well, if we zoom out a bit, what we're seeing is this convergence of three different demand drivers. The perfect storm, really, in a good way.
Okay.
First, you have corporate travel. It's back. I mean, it is back in full swing. We're not just talking about Zoom calls anymore.
The handshake is back.
The handshake is definitely back. Businesses are moving people around again, sales teams, executives, conferences, all of it.
Okay, so that's number one. What's two?
The wedding season. And in India, you can never, ever underestimate the economic power of the wedding season.
Oh, for sure.
It's a massive engine that just drives Q3 and Q4 for hospitality. And it is absolutely thriving right now.
And the third?
The third is this resilient domestic leisure demand. And this, to me, was the most interesting part of the analysis.
Oh, so...
Because a year or two ago, a lot of analysts thought this post-pandemic travel boom would just fizzle out. They called revenge travel a bubble.
Right, that it would just pop.
But it hasn't. It's stabilized into this really robust kind of permanent demand for travel, both in cities and vacation spots. People have just decided that, travel is part of their lifestyle now.
So people are really prioritizing experiences. But here's the part where it gets a bit technical. The report mentions a key economic concept that's driving all this profitability.
Mm-hmm.
Demand is outpacing supply.
And that is the absolute critical piece of this puzzle. That's it. It's just economics 101.
High demand and low supply. That means pricing power, right?
Precisely. The report specifically says operators are able to maintain pricing discipline, which is, a very polite analyst way of saying they can raise their room rates.
The average room rate, or ARR.
Exactly. They can raise the ARR without scaring away customers because the supply of new quality hotel rooms just hasn't caught up yet.
So they can charge more and still keep the rooms full.
That's the idea.
There was also a note in there about international relations, which felt like a bit of a geopolitical curveball in a hotel report. Why is that relevant?
It's surprisingly relevant.
Yeah.
The report highlights improved trade relations, specifically with the U.S. and the EU.
Okay.
Now think about what happens when trade relations improve. You get more trade delegations. You get more global summits. You get C-suite executives flying in to sign deals.
And those folks are not staying at a roadside motel.
Exactly. They're booking the suites. They're booking the conference halls. That creates this whole slipstream effect that really bolsters high-end hospitality. And the report expects that to continue all through 2026.
So the wind is definitely at their backs. Let's look at how Apeejay Surrendra Park Hotels, ASPHL as they call them, actually performed.
Mm-hmm.
The headline for their Q3 is literally best ever Q3 performance.
It's a strong claim, but yeah, the numbers back it up.
So let's do the highlight reel. Net sales hit Rs 2001 million.
Which is the first time they've crossed that 2 billion rupee mark in a quarter, I believe. Up 12.7% year-on-year.
Right. And EBITDA is up to Rs 706 million with a margin of 35.3%.
And I want to pause on that EBITDA margin for just a second. 35.3%.
Yeah.
For anyone who doesn't stare at balance sheets all day, EBITDA is basically your operational profit.
Yeah.
And a 35% margin in the hospitality business is, well, it's very significant. It shows they're not just making revenue, they're efficient.
They're keeping a healthy chunk of every rupee.
A very healthy chunk.
So speaking of the front desk, let's talk about the occupancy rates. I honestly had to double check this because I thought it was a typo.
I know the one you're talking about.
The Parkota,
Wow.
100% occupancy.
100%. It's almost unheard of.
How is that even possible? I mean, it's a full house every single night.
It implies they're literally turning away business. Or they have just managed their inventory to absolute perfection. And it's not just Kolkata.
No.
The Park Chennai was at 96%. Bengaluru and Avi Mumbai were both over 91%. These aren't just good numbers. They're outperforming their peers by a significant margin.
So nearly every room is full, nearly every night.
They are. And this connects right back to that supply-demand imbalance we were talking about. But I do want to add a little nuance here.
Okay.
Usually when you see 100% occupancy, as an investor, you might actually get a little worried.
Worried? Why? I thought a full hotel was the goal.
Not always. Because if you're 100% full, it could mean your prices are too low.
Ah, I see. You're leaving money on the table.
You might be leaving money on the table. You could have charged 10% more and still been 95% full, which would actually be more profitable.
But that's not what's happening here.
No. The report notes they have competitive average room rates and high occupancy.
So they're charging market rates or even premium rates, and people are still packing the place.
That is the holy grail. It proves you have strong brand equity. People aren't staying there because it's cheap. They're staying there because they want to be there.
It's the difference between being cheap and being in demand.
Exactly.
Now, speaking of brand equity, I want to pivot to what I think is the most fun part of this entire business.
I think I know where you're going.
We're talking hotels, sure, but we're also talking about cakes. Let's talk about Flurys.
Ah, yes, Flurys, the legendary tea room brand. This is fascinating because usually a hotel's F&B is just a support service.
Right, a utility. You need a restaurant so your guests can have breakfast.
Exactly. But for ASPHL, Flurys it's a beast of its own.
Beast is the right word. You have to listen to the stat from the report. On Christmas Eve, Flurys recorded a single-day sale of IRS 1 crore.
1 crore.
1 crore in one day. That is an incredible amount of pastries. I can't even compute how many transactions that must be.
It's a staggering number for a retail food brand. And it signals that this isn't just a Kolkata nostalgia thing anymore. This has legitimate national commercial power.
Oh, it's definitely growing. The brand saw 19% top-line growth in Q3, and they're not slowing down. They're adding 14 new stores just in this quarter, Q4 of FY26.
And the long-term goal?
They want to hit 150 to 160 outlets by the end of FY27.
Now, this is where it gets really interesting from an investment perspective, because this diversifies their revenue stream in a huge way. Hotel revenue can be cyclical.
Right, business travel slows down, or there's a lull in weddings.
Precisely. Or a bad monsoon season keeps tourists away. But a retail bakery chain with a national footprint, that provides a steady, high-frequency cash flow. People buy coffee and cakes year-round. It smooths out the bumps.
It really changes the nature of the company, makes them feel like a hybrid hospitality and retail company.
It does. And retail businesses often get higher valuation multiples than hotel businesses because the revenue is seen as more predictable. So Flurys isn't a side hustle. It's a strategic pillar.
But they aren't just sitting on their current properties either. They're buying new ones.
Correct. They're in an aggressive expansion phase. The report details a few key acquisitions, like they picked up a 76% stake in a property in Juhu, Mumbai.
And for anyone who knows Mumbai real estate, Juhu is, well, it's prime. It's high-end. It's near the beach.
It's a very high barrier to entry market. You can't just go and build a new hotel there. Land is incredibly scarce. So buying into an existing property is a very strategic move.
And they're going south, too, right? Into Kerala?
Yep, they acquired Malabar House and Purity Resorts. Those are going under the Park Collection brand.
So they're capturing that leisure market.
That's the idea. The management has a clear target.
Yeah.
They want to add 672 keys, that's industry speak for rooms, over the next 14 months.
The goal being?
3,219 keys across 56 hotels by the end of FY27.
That's substantial growth. But there's one more piece to this puzzle that I found a bit complex, but the report suggests it's where a lot of the hidden value is. The Pune property. Can you explain what's going on there? It sounds more like a real estate play than a hotel play.
It absolutely is a real estate value unlock. And this is the kind of detail that separates a casual observer from a serious investor.
Okay, lay it out for us.
So they own land in Pune. Recently, a new metro corridor was developed nearby.
And infrastructure like that usually changes the game for real estate owners.
It changes everything. When a metro comes in, the local government often allows for an increase in what's called the FSI, or Floor Space Index.
Okay, so in simple terms, FSI dictates how much you can build on a piece of land.
Exactly. It's the ratio of the building's total floor area to the size of the land. Higher FSI means you can build taller, you can build more.
And what did that do for them in Pune?
Before the metro, their potential development area was about 2.5 lakh square feet. Because of this FSI increase, that potential has jumped to over 6.7 lakh square feet.
Wow, that's more than double, almost triple the developable area.
It's a massive increase. And think about it, without buying any new land, the land they already own just became exponentially more valuable.
That's value that doesn't show up in the daily room rates. It's just sitting there on the balance sheet.
Precisely. The report calls it significant value creation. They aren't just running a hotel there anymore. They're real estate developers sitting on a gold mine.
And they have another cash cow in Kolkata too, right? The Park Unison project.
Yes, that's a residential development. The report estimates it will generate between Rs 3,000 to 3,500 million in cash flow over the next 3 years.
3.5 billion rupees in cash flow. That's a serious war chest.
It is. And that cash connects right back to the balance sheet. It strengthens your ability to fund all those acquisitions, Juhu, Kerala, the new Flurys stores, without loading up on high-interest debt.
That's a crucial point. It funds the growth engine internally.
Right. The Kolkata real estate is paying for the Flurys expansion, essentially. It makes the company much more resilient. And the report touches on that financial health. They have a net worth of Rs 13,290 million.
A solid foundation.
Very solid. And they have substantial liquid investments available. This is vital. It means you can pounce on opportunities. If a great property comes up for sale tomorrow, they don't have to scramble for financing. They can just move.
So let's bring it all back to the IDBI Capital recommendation. They're saying BUY. Target of Rs 175. How are they getting to that number? What's the math?
They're using a standard valuation methodology, EVELDATA. They're assigning an 11x multiple based on their estimates for the financial year 2028.
2028. So they're looking a couple years down the road.
You have to with an expansion story like this. The acquisitions they're making today won't show full profit tomorrow. It takes time.
Okay.
And IDBI is projecting the earnings per share, the EPS, to jump significantly. They expect it to go from about RES 3.9 in FY25 all the way up to RES 8.8 in FY28.
That's more than doubling the earnings per share in 3 years.
It's aggressive growth.
Yeah.
And they also see return on equity improving to 12% by FY28. So the argument is you're buying a company today at RES 126, but you're paying for a company that's going to be significantly larger and more profitable in 2028. The market hasn't fully priced that in yet. And that's where you get that 39% upside.
It really does seem like they're firing on all cylinders. It's not just one thing going right.
And that's the strength of the thesis. It's diversified. If corporate travel slows down, you have the wedding season. If the hotel side has a quiet quarter, you have the Flurys expansion pumping out cash.
And underneath it all,
you have this deep real estate value in Pune and Kolkata that provides a safety net and future capital.
It feels like a very balanced three-legged stool. Operations, retail, and real estate.
And they all seem to be working in harmony right now against the backdrop of an industry upcycle. You couldn't really ask for a better macro setup.
It does make you wonder how we categorize these companies. We call them park hotels. But when you look at Flurys, when you look at the growth there,
it raises a very important question about valuation multiples.
That's actually the thought I want to leave everyone with today. We think of this as a hospitality stock.
Right.
Hospitality stocks trade at certain multiples. They're asset heavy, they're cyclical. But if Flurys hits that target of 160 stores, if they're generating crores and crores from cakes and chocolates, at what point does the market stop viewing them as just a hotel company?
And start giving them the valuation premium of a, say, FMCG or a retail player.
Exactly. Because retail companies often trade at much higher multiples than hotels. If the market starts valuing that slice of the business like a retail stock, that price target could look very different.
That's the potential re-rating catalyst. It's not explicitly in the numbers yet, but it's definitely in the story. If Flurys becomes a dominant national brand, the whole identity of the stock changes.
You stop being a hotel that sells cakes.
And you become a lifestyle brand that also offers hospitality.
A big shift. Something to chew on. And that's it for this deep dive into Apeejay Surrendra Park Hotels, a complex story of rooms, real estate, and rumbles. Thanks for listening.
Thank you.